For the fourth time this year, the European Central Bank has cut interest rates, this time by 1/4 percentage point. It kept the door open to further cuts as growth is hit by political instability at home and the threat of a fresh US trade war. ECB Chief Christine Lagarde.
We are determined to ensure that inflation stabilises sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path.
The ECB has been easing policy as inflation worries largely evaporate. The debate has now shifted to whether it's cutting rates fast enough to support an economy that's lagging global peers. Predicting that inflation will be back at its 2% target in early 2025 and that growth will remain sluggish, the ECB lowered its deposit rate to 3%. It also changed its guidance, likely to be taken as a hint of further rate cuts. The ECB's earlier policy statement had omitted a previous promise to keep policy sufficiently restrictive. Some say this signals a return to at least a neutral setting that neither stimulates nor slows growth. But this signal was less forceful than many economists had expected, especially as it came with a warning that domestic inflation remains high. The ECB warned downside risks remain, with Germany facing an early election, France struggling to find a stable government, as well as President-elect Donald Trump threatening punitive tariffs.